webinar. We have had a number of webinars in this webinar series, starting with the 3 things everyone needs to know about their money, moving on to the 2 biggest mistakes people make with their money, and then we've been talking recently about the major wealth transfers that everyone has, which are starting with the mortgages we went over last week, and today we're going through the second one, qualified plans. The third one will be on taxes and college funding, and then the last one will be on major capital purchases. So we're really excited for this topic today. One of my favorites, qualified plans, and I think it's one of my favorites because it is something that everyone has. Almost everyone in this country has a qualified plan of some sort, and yet I would probably say that nobody actually understands them. I'm here with my mentor, Doug Foster, who's been in this 30-plus years. Doug, what would you say? Out of all the people you've met with in 30-plus years, how many people do you think understand their qualified plans?
Very few. And at the tail end, I always ask people, what is your exit strategy? And I have yet to have anybody tell me that they have an exit strategy. And that's very important because you got to climb the mountain, but you got to get back down.
That's exactly right. And so this is a very, very, very important topic, and it applies to a ton of people in our country. And so I think, you know, if we understand this, it'll go a long way. Now, as you can see on the screen here, there are several qualified plans. One we talk about the most would be the 401k. So a lot of times we reference this as a 401k, you know, topic. But in reality, it's a qualified plan topic because it encompasses several different types of qualified plans. The 401k is probably the most popular, and then, of course, the traditional IRA, which is very similar in taxation, in fact, exactly in taxation. And so those are the 2 you hear a lot about. You hear, of course, a lot about the Roth IRA, but there's lots of other ones. There's annuities out there. There's a simple, there's 403B that you get a lot in nonprofits and schools and things like that. There's KEO plans and SEPs and simple plans for self-employed individuals. So lots of different types of qualified plans, but they all have a couple of things in common. First of all, the first thing they all have in common is that they defer the tax. Now, that defer word is something that we always find important to clarify because it definitely is something that a politician came up with. But the defer word actually means postpone. Real quick, you know, you probably heard the analogy that if you were going to come to me for a loan and I was going to give you some money, you would probably want to know a couple of things about that loan. Number 1, what the interest rate is, and 2, what the terms are of that loan. And if I said, well, you know, I'm doing pretty well right now financially, so what if we were to wait until later when I wasn't doing so well financially and I needed money? Then what if I could determine then what interest rate I needed to charge you and when I needed that money back? Would you take that loan? And of course, most people would say no. However, it is important to understand that that's what we are doing with a lot of these qualified plans. We are postponing the taxes until later. So the question is, we are not only postponing the taxes until later, but we are also postponing the tax calculation. We don't know, first of all, what tax bracket we're going to be in retirement. That is something very important to understand. Here's a quick way to calculate, you know, what your tax bracket is. You could, of course, go on to your tax table, and you can Google this kind of thing as well. But first of all, you need to know what your tax bracket is. And then the other thing to consider is you need to actually know what your tax bracket might be in the future. One of the things that I think is interesting is even if they didn't even change the tax brackets as they are today, just through inflation alone, over the next 30 years, your income, of course, would inflate, which could naturally put you into some of those higher tax brackets. And so I think that is something to consider, and I think that's something you need to understand. So which tax bracket will you be in at retirement? Something very important to understand and ask yourself that. Also, what deductions will you have when you take out the money? Everyone is so anxious to get their kids out of the house and become empty nesters and get that mortgage paid off. So the question is, if you do that, what are your tax deductions in retirement? And is that something you should be doing? Now, I'm not saying you shouldn't be getting your you shouldn't be getting your kids out of the house. I don't know that anyone wants them to stay forever, but that is something to consider as far as future tax brackets and tax rates. And so let's take a look at, first of all, tax thresholds. Your tax thresholds are a couple of things. Number one, if we go way back to 1913, I think this is, to me, this is just fascinating stuff. If we go way back to 1913, the very top tax bracket was just 7%. Remember, this was only going to be something temporary. You know, the taxation of the country was going to be something very temporary just to get through this initial little phase. Now, what we're going to look at here is what we call the country on drugs, or the country on tax drugs. And what happened was, is it started out at 7% for the top rate if you were making over $500,000. Well, some interesting things happen, and a lot of times we only focus on the top tax rate. And if we look at just the top tax rate, it goes from 7% to 15, 67, into the 70s, and so on. However, what we also ignore or don't notice a lot of times is these thresholds. And as you can see, it can go from $500,000 up to $2 million to $1 million, and all the way down to 200. You've probably heard Don Blanton say that down in the South, that's what they call casting a wider net. When you're out shrimping and you're needing to catch more shrimp, you cast a wider net. So if you are not getting enough money at $1 million, top tax, threshold there, then you lower to 200,000. And even by lowering the tax rate down to 58% from 73%, by casting a wider net, you are going to get a lot more money that way. So if we look at this, you can see a couple things. Your top tax rate, which, as you can see, has gone all the way up into the high 80s. Here's another one of my favorite that I've pointed out before. In 1941, you were taxed at an 81% rate if you were making over $5 million. Now, there were maybe a handful of people in our country that were making over $5 million at the time. But what I think is extremely fascinating about this is in 1942, 1 year later, the rate went up to 88%, and then, of course, they casted that wider net. They dropped it from $5 million down to $200,000, and that is a very significant indication as to what they can do to modify and to change this. And then, of course, like a lot of people, are not aware, we were into the upper tax brackets of tax rates of 94%, which is just significant, making over $200,000. Now, down here, if we fast forward in time, we come down here to the 80s, and in the 70s, back up. In the 70s are when we really started to look at the fact that these executives in our country making over $200,000 a year were paid over 70% in that top tax rate. And they started petitioning the government for the ability to supplement, and we'll come back to this in a minute, but they were wanting to supplement their pensions by 20 to 30% with something that they could postpone until later and pay taxes later when they were out of that 70% tax rate. So, of course, they came out with the IRA, and then they came out with the 401k. In 1981, the first 401k went into effect, and so that allowed people to, in essence, kick the can down the road until they were in a lower tax rate. So when they started to pull the money out, they would not have to pay as much in taxes. Now, what I want to point out, let's go back to just another little visual of this, is as you can see with some of these events that we just talked about, we just highlighted that what happened in 1941 and 1942. We can see over here in the 70s when that went into effect. Now, from a visual standpoint, if you look at this, are we taking the can and kicking it down the road if we were putting money into a qualified plan like a 401k or an IRA back in the 70s or early 80s? Yes, it looks like it from history here. The question is, are we still kicking the can down the road, or are we kicking the can uphill? That is the big question, and that is what we have to understand when it comes to qualified plans, because in a nutshell, we need to know, are we going to pay more taxes in the future or less taxes in the future? If you ask 100 people, you're probably 99 out of 100 that are going to say the taxes will probably go up. And the reason a lot of people would say that is because something that we call this debt that the country is in. This is, of course, the debt clock. Many of you have maybe seen this, but I swear every time that I pull this up, we're an extra $1 trillion in debt. So it's amazing how fast that can happen. So we are now, as you can see here, there's a lot of numbers on the screen. It's a little busy, obviously, but right here you can see that we are over $18 trillion of debt. So if you were the country and you were running the country and you needed to get out of debt, what would you do? Would you cast a wider net? Because if you would cast a wider net to pick up some extra taxes, then of course that means taxes are going to go up. Let's talk about what that actually does to your account balance. For easy math, let's just say you have $100,000, which is always my favorite question when I talk to clients. I ask them, how much money do they have in their qualified plan? And they'll say $100,000. It's just like asking somebody how much equity they have in their house. If they say $100,000, generally I would say, well, do you have that $100,000 of equity, or does the bank have that $100,000 of equity? So it's the same thing with your qualified plan. Do you actually have $100,000 in your qualified plan, or do you have a partner in that investment? And if you are at a 30% tax bracket, then yes, you actually do have a partner. And believe it or not, you only have $70,000 in your qualified plan, and the IRS is a 30% owner in that account. So of course they are getting interest on their money as well. You are saving and investing and helping them out as well as yourself. So once again, the big question is if we turn on the average line and we look at how the average in the country has been almost 50% to that upper tax bracket. Now, a client the other day said, well, I'm never going to be in that upper tax bracket. Well, first of all, we just showed you a minute ago that with inflation, you very well could be in that upper tax bracket if they don't change anything. Just based on inflation alone, if your income inflates at 3%, you could very easily be in that upper tax bracket. The second thing I would say to that is if we work together, our goal is to help you retire, better off than you are today. So hopefully, we're going to get you into a better tax bracket is the goal, because we want you, or it depends on how you look at it, it could be worse. But we're trying to increase your situation or increase your income. Well, the other thing to consider is even if you're not in the upper tax bracket, that doesn't mean that even in the second or third tax bracket, you're not going to experience some of this up and down of taxes. And so you need to still consider the fact that your taxes could go up. And if they go up to even close to that average, around 60%, it is possible, as you can see from history, it is possible for the IRS to actually have a larger ownership in your account than you do. And that is something to consider. When we talk about wealth transfers and when we talk about transferring away money unknowingly and unnecessarily, I would say that the reason why this is number 2 on our list is because here's an example of some serious wealth transfers that you don't even know about that could potentially be avoided with a little proper planning, right? So that's kind of the little intro to the taxation. Now, once again, qualified plans postpone the tax and the tax calculation. So let's look at that. If you are contributing $5,000 a year and you're currently in a 30% tax bracket and you plan on taking the money out at a 30% tax bracket and you have 30 years until you are going to pull that money out at a 5%, or we could even throw a 6% investment return in there, then what happens is that even though your account balance is going to grow to $419,000, your share of that is going to be $293,000. The amount due to the IRS is going to be $125,000 because you thought you saved about $45,000 or deferred $45,000 in taxes. However, we have to calculate tax at interest. And so once again, the IRS loves the idea of compound interest just as much as we do. So they get their little compounding just like we do. And so we are going to, of course, have to pay them $125,000 in the future. Now, that, of course, can change based on your tax bracket. If it goes down, things will change accordingly. If it goes up, things will change accordingly. And that's something that everyone needs to understand, because that is a real amount there. That's real money that has to be paid. Now, the other thing to consider is that during your career, you may be in several different tax brackets. You may start out in a lower tax bracket, just trying to get started, and you're just getting started in life, and you're working your way up to maybe that high income tax bracket. And then maybe when you pull money out, maybe you remain in that high tax bracket because you are trying to, of course, stay at that same style or same standard of living. Well, one of the things that you have to figure out is even if you got a different rate of return on your investments during those different time frames, you have to look at the average of all of those periods averaged out. And you can see here that the rate of return for this particular scenario is 6.35 if you look at how the taxation is affecting that. So that's something to also consider, is even though you're going to be in different tax brackets throughout your life, there is still, that is still, the taxation still has a big effect on that. We already looked at that. Let me jump ahead here. Oh, there we go. Okay, so here are the two options. This is probably, if there's nothing else that you get out of today's webinar, this is probably my favorite screen that answers the most questions that people have, which is, if they are going to be contributing $5,000 a year and you suggest that they might want to consider paying their taxes now, the first question everyone is going to say is, well, then I have to pay my taxes on that $5,000, so I'm not going to have as much money going into my investments. And so the common thought is that the 401k that gets to go in pre-tax, it gives them that feeling that they're actually saving more money. So $5,000 is $5,000 going into that account. So the number one question that I get from clients when you're comparing a 401k with a Roth IRA or life insurance or something that you're paying taxes now that you don't have to pay taxes later, the number one question or objection, I guess, that I would get is that you're going to not have as much money going towards your investments. That is true. That is a true statement. You would only have, in this particular case, if you were in a 30% tax bracket, you would only have $3,500 going towards your investments. And so as we can see here, over there on the left, we have the full $5,000, because if we look over here, let me go back to our favorite personal economic model and just give you a quick visual on this. If we have all of our money, going into this investment tank over here through a qualified plan, we are skipping this initial tax filter in the beginning. The question is when we have to open up, when we open up this valve here and let the taxes, or let the money come out, are we paying taxes on that? Yes, and that is why we have the red in this tank. The red represents the part that is owed to the IRS. So the piece or the percentage that is owed to the IRS. So as that money comes out in the future to support your future lifestyle, that will still eventually get passed through the tax filter. So coming back over here now, that $5,000 that you are saving into your qualified plan will grow your balance to $419,000. That's significantly more than $293,000. So if you run with some basic calculators and you're not looking at the whole picture and you're not calculating all of the numbers, you might look at a basic calculator and think, well, heck, if I save the $5,000 instead of the $3,500, I am going to have more money in my account. That is technically true. There would be more money in your account. The question is do you own all of that money? And of course the answer is no. That's why the red that we just showed you represents the account or the percentage that belongs to the IRS. So as you can see here, the amount due the IRS is $125,000, which puts your net withdrawal at $293,000, which is the exact amount that you would have in an after-tax contribution. Now, all of this is assuming that we are going to, be currently in a 30% tax bracket and retire in a 30% tax bracket. If you are currently in a 20% tax bracket and you are going to retire in a 30% tax bracket, it would behoove you financially to have your money in a after-tax contribution scenario. The two options would be the Roth IRA and the life insurance. So the life insurance and the Roth IRA would be your two options that you could pay your taxes now while you're in that lower tax bracket and be able to pull the money out tax-free. So even if taxes went up, well, let's just go back to that 60%. Let's say you did really well in life. If you did really well in life and you ended up in that higher tax bracket, that highest tax rate, and they raised, the taxes back up to around the average rate at almost 60%, that would not affect you if you paid your taxes in the beginning when you were at a 20% tax bracket. So these are some very important things to consider. Now remember, back in the day, these executives were in a 70% tax bracket, and now they're all retired, probably in a 30% tax bracket. So did that work for them? Absolutely. Did the IRAs and the 401ks do what they were designed to do? Yes, they did. They were designed to postpone taxes until later, and that's exactly what they did. You just have to decide whether that is the best scenario for you. And of course, everyone's situation is different. But if you believe taxes are going to go up in the future, and if you believe you're going to be more successful in the future, then you might want to pay your taxes now. If you don't believe that you're going to be more successful in the future, well, then we need to talk, because that's why you're on this webinar.
There's some other issues on that too.
Yeah, go ahead.
Well, there's also some other issues, and I might be stealing Lance's thunder right here, but you have to look at liquidity, use, and control. Is your money locked up in the 401k? The answer for the most part is yes, whereas the other, it does not have to be locked up. You're in much more control. Secondly, in the 401k IRAs, usually those sub-accounts are in mutual funds, and are the fees compounding over time? The answer is yes. So they're at an all-time high in most cases the time you're getting ready to take distribution. That does not have to be the case, and that can certainly be helped tremendously in the using life insurance companies. And then lastly, or at least one of the last things for now, would be a distribution. Is your money usually at risk in the 401k or IRA? And the answer is, in most cases, yes. And if you get more conservative, then you're going to have less return. With that volatility, it's going to dictate that you're going to end up, because of the bumps along the way, probably with a small percentage for distribution. If you don't have to worry about going backwards, if you can keep those fees in check, you're not paying taxes if you do it right, and because you're not going backwards, there's no risk, you don't have the volatility, you can take out a substantially more distribution at retirement, and that's a big deal if you're going to live another 30, 35 years between you and your spouse.
Absolutely. And in fact, for more information on that, go to changelife.me, and under the members only link, we have some recordings of the first webinar series. The first webinar was the 3 things you need to know about your money: taxes, which we've reviewed today, and impact of losses. And Doug, mentioned the ups and downs and the bumps. So review that, training on the impact of losses. And then the second webinar is the fees. And of course, Doug spent an entire webinar explaining those fees. So if you want more information on 401k fees and how that compares with other options, make sure you review that training as well. And then, of course, the last one we talked about just 2 weeks ago was on the 2 biggest mistakes people make with their money. Number 1 is not having access to it. And that is one of the things that we noticed. Doug and I, when we're meeting with clients, we noticed that they have all of their money tied up in equity in their house and in a qualified plan at work. And when life throws them that curveball, or life offers them an opportunity, in either scenario, if you don't have access to that money, it can be tough. Now, the second mistake people make is they interrupt the compounding. And so a lot of people love to get loans against their 401ks. I've talked to several people recently that is their savings account. They always go to their 401k and pick up a loan because it's easy to get to, and it's easy to access money that way. The problem is they actually take the money out of the market and stop the compounding. So you interrupt compounding, and of course, compound interest works best over time. So those are 2 big mistakes that people make, and you need to understand how that applies with these qualified plans. So very good, thank you. Now, that hopefully will help you to see that if you are currently in a 30% tax bracket and you plan on retiring in a 30% tax bracket, it does not matter which one you choose. But if you believe taxes are going to go up in the future, you might need to look at that. The other thing to consider is if you are really in love with your 401k and they're giving you a great match, and you really want to take advantage of that, which sometimes you might want to actually do some comparisons on that. But even if you do, you might want to consider a Roth 401k as something that at least allows you to pay your taxes now on your contributions. Now, the employer's contributions will still go to the traditional side, but your contributions could actually be the Roth 401k option that allows you to pay your taxes now and be able to pull that portion out tax-free in the future. So all things that you need to consider on these qualified plans. Okay, now, however, the one thing that qualified plans do that is very, very powerful and very effective, and this applies to a lot of different investments, not just qualified plans, but qualified plans, well, actually, qualified plans like annuities that would fit into here, IRAs, Roth IRAs, life insurance, a lot of things that fit into this category of being able to have your money grow tax deferred versus paying taxes. That is something that is very powerful because, as you can see, if we're saving $5,000 and we are even getting a match on that, a 50% match on that, and our current tax brackets, are in the 30%, our withdrawal tax bracket is in the 30%, and we are going to wait 30 years before we pull the money out at a 6% rate of return, the qualified plan would grow even after you pay the IRS their portion. Your net withdrawal of $439,000, because your money was able to grow tax deferred, is significantly more than if you were paying taxes along the way, because not only do you have to pay the taxes, but there's the loss opportunity cost on the money that you pay in taxes. So that is all something that you need to consider. I had a client once that was selling some real estate, and he was going to be left with about $2 million after the sale of the real estate, and he wanted to know where to put it. And I asked him what his perfect scenario looked like, and he said his perfect scenario was to put it in the bank that would give him 8%. Because if the bank would pay him 8%, he thought that would be the perfect scenario. But what he wasn't calculating is that at 8%, he was at the highest tax bracket. He was paying about 40% in taxes. At 8% in the bank, you're paying 40%. You're paying ordinary income on that 8%. So every year, you may get a gross return of 8%, but then you actually have to pay 40% of that in taxes. And so that is something very important to understand when it comes to how your investments are being taxed, whether or not you're having to pay taxes every year on the gains, or whether your gains get to grow tax deferred. And this screen is very powerful, whether we're looking at any type of qualified plan. As long as it allows you to defer taxes, have tax deferred growth, that is a very powerful feature to have in your qualified plan. Okay, so 3 important questions to ask yourself. What tax bracket will you be in at retirement? If you're convinced that you're going to be in a lower tax bracket in retirement, then that is something that you need to consider. But most people would probably say they're going to be at a higher tax rate. They're going to be taxed at a higher tax rate in retirement. The second question, what deductions will you have when you take out the money? The never-ending argument between my mom and my dad is that she wants him to pay off the house and he refuses to pay off the house. He was an accountant his whole life. He retired at 57 with all of his money in real estate, and all that money in real estate is paying him income, like rental income. It's income. And so, of course, that's income tax. So he has to pay taxes on all of that income coming from his real estate investments. But his real estate investments are growing in the double digits, and his mortgage is only costing him 3. So review our training on mortgages to understand that. But do you really want to pay off your biggest tax deduction? The question is no. The minute you pay off your house, you start to construct a house for the IRS with the extra taxes you're paying. So what tax deductions are you going to have when you are in retirement? I don't know that you want to convince all your kids to move back in with you. So your mortgage may be your biggest tax deduction. Maybe you need to consider starting your own business. Maybe you need to consider a home-based business. The average, home-based business owner saves $3,000 to $5,000 a year in taxes just on some of the typical write-offs that you can have through a home-based business. You might need to consider all of these tax deductions that you're going to have in retirement. And then, of course, Doug mentioned earlier, what is your exit strategy? Now, Doug, why don't you elaborate on that a little bit? What do you mean by what is your exit strategy?
Well, how are you going to distribute that money later? There's a principle called sequencing. We'll save that for another meeting, but what money do you take from where? How do you integrate and coordinate all your assets together? For most people, a lot of their money is in their 401k, but a lot of people have money in other places too. But we want to make sure that we can distribute the money efficiently, effectively, the timing, and the number one thing that people as they approach retirement or are retired have is that they do not want to run out of money. There are ways that we can assure that can happen, and that's certainly worthy of a good conversation about that.
And I love the analogy that Doug uses where he shows a picture of Mount Everest. He says, what's the goal? And everyone says, to get to the top. But the real goal is to get to the top and get back down, unless you'd like to live on the top of Mount Everest. But the goal, of course, is to get back down in one piece. And one of the things that I have learned from Doug as my mentor is the distribution phase of retirement is a lot more complicated than you think. You don't just start peeling out a little bit of money to live on. You have to look at how that integrates and coordinates with Social Security. Maybe you want to spend down some of that 401k money and get it out of the way so that you don't have future taxes to worry about. Maybe you delay Social Security a little bit. Maybe you want to move that into a Roth IRA. Maybe you want to move it into life insurance and get some of those taxes out of the way now so that you can pull that money out tax-free 10, 20 years down the road. A lot of times we use a bucket approach. First 10 years of your retirement, we pull money from bucket number 1. In the second 10 years of retirement, we pull money from bucket number 2, and so on and so forth. And we can do that in a very strategic way. And so today, hopefully this was very insightful and helps you to see some of the information of qualified plans, and it's important to understand it. We're not saying that they're bad. We're simply saying that you need to understand them. And so I'd like to close the webinar today on an extremely depressing note. And the depressing note is that the 401k was never designed to retire you at 100% of your income in retirement. They were designed to supplement a pension. Unfortunately, Wall Street, the government, large corporations, they jumped on this 401k bandwagon and they looked at it as a great way to get rid of pensions, a great way to postpone taxes until later so that the IRS can control how much of that they get. And of course, the fees that come along with that make everybody on Wall Street extremely wealthy. So there are a lot of people that want you to believe that a 401k will retire you. Even if you get a company match, and even if you get a dollar-for-dollar match, it is very difficult, if not impossible, to invest enough money to actually replace 100% of your income in retirement. So either way, you are going to have to supplement your 401k with something else if you ever want to retire. So you might need to compare it with other options that are out there. You may need to see if this is a wealth transfer that you're transferring away unknowingly and unnecessarily, and you may need to see, if there are ways to significantly decrease the amount of money it takes you to actually retire. And with some of the stuff that we teach with avoiding losses, minimizing these taxes, and some of these other strategies that we have in place, we can significantly help people, even double, triple their income in retirement with some proper planning. So make sure you meet with someone to get help on your situation. But if you can see here on the screen, even at a 7% return with 1.5% in fees, which is generous, and that's pretty low. If you're in a 30% state and federal tax bracket, if you would like to retire on $5,000 a month spendable income, if you would like $5,000 a month, you would need to save $1,300 a month for 40 years and all the way up to $5,000 a month for 20 years. Now, I meet with a lot of people in their 40s that are just starting to think about retirement and just starting to take retirement seriously. So if that's the case, they would need to be saving $3,500 to $5,000 a month, even to have a $5,000 a month spendable income. Now, to make matters worse, this isn't even factoring in inflation. what is $5,000 a month spendable going to be in 40 years or in 35 years? So with that depressing note, I will end this conversation on qualified plans and let you know that there is hope, there are solutions, there are some things that you can do to avoid these wealth transfers. So meet with your financial mentor and have them help you out to make sure that you are being as efficient as possible and plugging all the holes in that bucket of yours. With that, thank you for your time. God bless. Have a great day.